Madam President, thank you. It was a few weeks back I was on the Senate floor visiting with my colleagues about the Federal Reserve's response to the failure of the Silicon Valley Bank. And I, again, am here today, this time to, in more specific terms, indicate there needs to be a pause in any new banking regulations until an independent investigation of the Fed's response to the failure at Silicon Valley Bank. I ask for and would again reiterate the importance of an independent review and indicate that that review should be done prior to the enactment of new capital requirements in order to ensure that these new regulations are properly tailored. Led by a nonpartisan financial expert uninvolved in the federal response, an independent investigation would allow a clear picture of what reforms are truly necessary. Instead, new capital requirements are largely based upon the Fed's, quote, holistic review, the origins of which are vague at best. Regulators have now proposed a host of new requirements and rules for mid-sized banks to conform to the same capital standards of the country's largest lenders. Lumping regional lenders in with global, systemically important banks ignore the congressional intent laid out in the bipartisan piece of legislation S-2155. Independent oversight might reveal these regulations to be an overprescribed or plainly unnecessary response to SVB's failure. While some measured regulations may be in order, implementing new capital requirements on healthy, well-run financial institutions will do little to prevent a similar crisis. Healthy levels of capital are necessary for strong banks and their ability to lend, but the lack of attention paid to downstream effects of higher capital requirements in the proposal is concerning. This is a sentiment that is shared, my sentiment, and it's shared by multiple Federal Reserve Board governors. Meaningful oversight from regulators requires objectivity and must be done without having a predetermined outcome in mind. It should come as no surprise that the Fed's remedy does virtually nothing to address the root cause of recent bank failures, poor bank management, and lax supervision. Instead, I worry that the regulations set in motion will serve as an opportunity for regulators to push a pre-established regulatory agenda that will dry up lending. It's widely acknowledged that the increase in capital requirements go hand in hand with reduction in credit availability. And with interest rates near a 20-year peak, access to credit for families and businesses is already shrinking. The draft proposal from the Federal Reserve would drive up the cost of home ownership for low-income households, underserved borrowers, and those unable to afford large down payments. Affordable housing is in short supply, and with mid-sized lenders forced to pull back on home loans, mortgage lending will continue to be pushed outside the highly regulated banking system. With continued labor shortages, elevated input costs, and supply backlogs, less credit availability is the last thing our housing market needs. To put it simply, there should be no new regulations until an independent review of Silicon Valley Bank's failure is completed. We need to know what we're doing before we attempt to do it. Regulations that significantly warrant increased transparency from the Fed. We need that transparency. An additional review would alleviate concerns about impartiality of the holistic review and ensuing capital requirements. The Federal Reserve itself recognized in its recent financial stability report that American banks as a whole were already well capitalized. Tightening capital requirements at the expense of lending will not prevent another SVB-type failure. A comprehensive response from policymakers and regulators would address the glaring supervisory shortfalls that preceded Silicon Valley Bank's collapse. Madam President, I yield the floor.